We are privileged to have Annette amongst us. Thank you for sparing your time and giving us your afternoon. We are happy to have you. Annette is the founder and CEO of Mid Capital. She is a chartered financial analyst with over 22 years of African experience in various fields in finance, including global markets, corporate finance advisory, investment advisory, and asset management. She has worked for several multinationals and global companies and spent a considerable amount of time working with small and growing businesses where most of us fall. So Annette is the right person for us today because she spent 6 years working for Standard Chartered Bank, 6 years working with startups and SMEs in the corporate and advisory space, and another 6 years leading another 6 years working with one of the leading asset managers, that is Stanlib. She was a general manager and a managing director. You're welcome, Annette.
Thank you.
Yes, Annette is also currently a board member of Britam Asset Managers Uganda, Red Oak Limited, and member of investment committee, Sprout Capital. Annette will introduce herself further. That is the little I could dig up about her. You're welcome, Annette.
Yeah, thank you, Mary. Am I audible? Can you hear me?
Yes, I can. I can also see you. You're looking very beautiful.
Thank you for inviting me, Primera, to this session. As Mary has said, I'm a finance person in and out, my background, but I've also led businesses as a business leader and a manager and a managing director. And I've also worked with businesses, small businesses, helping them structure their capital and look for funding. So I can say I'm all around. And the presentation will the finance is really, really wide. So I picked out areas that I thought would be helpful. And Mary has introduced me very well. I'm happy with the introduction, unless you need any other clarification. But I'm also the country lead for Girls Kenya. And I can see in the chat, I have my Kenyan alumni and mentors in there.
Wow.
As well. Yeah. So thank you for having me, and I'm looking forward. So, Mary, should I start, or are there any other?
No, now that we are done with the introduction, take it away.
Okay.
I am from a finance background. I am going to be very attentive today.
So that's very nice, because then you're going to support me where where I have missed out. Please feel welcome, join in and support me. Thank you.
I'm here.
Yeah. So as I was explaining, I've done a lot of work around finance. So I am not an accountant, and we will not be doing any accounts today. And I was told that the ladies in the meeting are entrepreneurs or aspiring entrepreneurs. So we shall be looking at it from a bird's eye view as an owner of a business. How should you be looking at the finances? So that's a perspective we're going to take for this session. So it's not going to be details of how to do accounting and that kind of stuff, but it is you as an owner. What should you be looking out? What financial skills should you have, and what you need to know is important for you to have and to prioritize. Yeah. So I'm going to share. Do I have the rights to share my presentation? I need to share the screen.
You should. Let me check. Try and see. I can see your screen.
I think I was meant to show the slideshow before I share, right? I'll just do that. Can you see my screen?
Yes, I can.
Yeah, so thank you and welcome everybody once again. Today we'll be talking about financial management, and like I've said, that we're going to be looking at it from a perspective of an owner or somebody who's looking after a business, or you want to start a business. So this is a webinar. Are the ladies able to use the chat function?
Yes, they are.
Okay, so before we start, I wanted to find out what the expectations are from this financial management session. If people could type in the chat, so that as we go along, I make sure that I cover what people are expecting. So ladies, kindly type in the chat what you'll be expecting from the MIF. What aspects of finance are you looking forward to listening to during this session? So I'm going to give you a few seconds to type in the chat. And Mary, am I meant to be seeing the chat because I can't see it on my side?
You are, and I can see it. So maybe I'll just go through as Primela tries to enable that for you. Ladies, over to you. Please share your expectations of the session. I think earlier I saw Anne's hand was up. So Agnes says she expects what systems she can put in place to make it easy to grow her business finances without eating all her earnings. Dorothy expects capital sources and matters to do with capital. Teddy expects how to grow her finances. Stella, how little or how much is sufficient to help her startup. Miriam, how to prepare her finance books for her poultry business. Stella, doctor, obligations of an owner in financial management, daily, weekly, monthly. Stella Mayanja, how to monitor the finances of her baby project. Daphne, pricing. Anne, sorry. Okay, Anne, I'll ignore your hand. Prosi, planning and budgeting for the business. Those are the ones I have in the chat box.
Thank you. Those are quite a number. Some of them I will cover, some I won't, because
some you will not.
They're quite detailed. They need a whole different lesson.
They need a debit credit session.
Yeah. So thank you, ladies. And before we proceed, could you kindly share what kind of business you are in as well, so that I have an idea? I did read the baseline form, but I'm not sure if those are the same people who are in the meeting. If you can type in your type of business, I think some ladies have already mentioned.
Yeah, I have more. When can I take a loan for my business? How to manage finances in terms of prioritization and emergency spending. Overcoming the stigma of quitting employment. How to tell the viability of a business early enough. So the businesses are poultry, produce, social enterprise, peanut butter, interior design, coaching and training, microfinance. I have an accounting firm, juice and soda distribution, fresh juice and general merchandise. Those are some of the businesses, Annette.
Okay, thank you, ladies, for sharing.
Consultancy.
Thank you, Mary.
Pharmacy. Yes.
Can I proceed?
I hope that gives you a good picture.
Yeah, it gives me a very good picture. Thank you, ladies. So the objective, we're going to go through why financial management and a few of the financial management practices and rules and some basics, and also financing, the different types of financing. So before we go into the financing, I just wanted, like you've seen the way everybody has posted something different in terms of your businesses. No one business is the same. So I want us to set a mind frame, a certain mind frame as we go to look into these finances. The first thing is you need to understand your business to be able to start, to understand your business, you will need the finances, the numbers. Then in your business, you need to understand your industry. As a business owner, make sure you try and find out what the industry you're in, what's happening in your industry. And so you have to keep abreast with what's going on around you. Do not remain in a silo and just look at your business alone. Then you need to understand the bigger picture. As a business owner, you need to understand the economy, because you might be pushing something that is not being supported by the economy, and then you're just pushing against the wall. So you need to understand the economy. This will help you in the growth. Some ladies have asked, they have mentioned things to do with growing business. How do I grow my business? So you need to understand the economy. And then you have to have a global perspective, because all the things we are doing have been done elsewhere, in other countries, on small scale or large scale. So you need to have a global perspective. So the first thing is understanding your business. You have to be able to tell your business story through your numbers. That's why the finances are really, really important. If you're doing poultry, you're doing peanuts, you're doing interior design, you have to be able to tell your story of your business through the numbers. It is not good enough to just talk about your business and the plans you have, but then you don't have numbers that are matching the story you're telling. So I'll be taking you through some of the tools that will help you tell your story in numbers. Then your finances should bring everything together. Everything, all aspects of your business, marketing, sales, whatever you're trying to do, whatever your objectives are, the finances should bring everything together. You should always tie finances in. Do not do anything independently of finances. So financial management is really, really key. It affects every part of your business. And then you normally have to have a business plan. If you want your business to grow, have a plan. But if it doesn't have financials tied to it, then it's an incomplete business plan. Then you're just talking, but you're not having the numbers. That's why it's very, very important to understand your business. And that's a perspective I want us to take as we go through the session this afternoon. The second thing is understand your industry. Do not work in silos, because industries tend to move together. Historical performance, you can assess that by industry. If you're planning to start a new industry, what kind of assessment have you done? Know which industry you're in, keep abreast what's happening in the industry, because it affects you. It always trickles down. It starts with the economy, comes down to the industry, but it will eventually trickle down to you. So if you're not aware, you'll be surprised by how your business is performing. So keep abreast of what's happening in your industry and make sure that you're aligned with your industry. In your industry, who are your competitors? Do you know them? And all these things, you find them in what we call a business plan, but I'm breaking it down to what you really need to know. And I'm trying to stress that do not work in a silo as just your business. Look at the bigger picture. So in that picture there, we're saying there's healthcare. As you're defining your business, you need to know, am I in healthcare? Am I in utilities? Am I in financial services? Am I in manufacturing? Am I in the fast moving consumer goods? So you need to know. And once you identify your industry, know what's happening there, know who your competitors are. That's really, really important. And then you need to understand the economy. What's the state of the economy? Is it in a recession or a boom? So what I'm trying to say that if you need to be good at your financials, you really need to also know what's happening around you. Are you listening to the business news? Are you reading the business section of the news? So that you understand what's happening and how your company will be affected. So that you do not plan for a business that is not going to go anywhere because that particular time is a recession. And also political things and things like elections. Are the elections coming up soon? How is that going to affect my business? Before you even start hustling, know these things, know the bigger picture. What is the government doing at the moment? Are they spending money? When government is spending money, you know, there's quite a lot of money in supply. So that can be a boost depending on what business you're in. So have the bigger picture, because that will help you plan and align yourself better to where your company can succeed easier. And then lastly is have a global perspective. And the good thing is that information is now very, very easy to access with the new innovations and technology. So on top of knowing your industry within where you live globally, because so much innovation has happened, you can now make big leaps and more and advance your product very fast. Be aware of the new innovation so that you don't lag behind. And then what are similar businesses like yours doing regionally and globally? What are they doing? And I wanted us to start off with that perspective because we are business owners. So before we go into the financials, we really need to have the bigger picture surrounding our business. And so basically, to be a successful entrepreneur, read the business section, listen to business news, gain knowledge, understand your financials, and think big. So that's my introductory session, and I would like to start you off with an exercise. I hope you came with your pens and papers to write down what business you are in, number one. We're going to do a reflective session on our businesses. What industry are you in? Are you able to identify that and write it down? And is that clear? Do you know who your competitors are? What is the current economic condition in where you are in the country? And how is your industry doing globally? So I just want you to take 5 minutes off and write down that about your business, and then we can get into the financial management. I had requested that we have a Zoom call so that I can look at people. Unfortunately, now I'm not able to see anybody. But I hope that you are writing down.
What happens if we can't answer some of these questions?
I would like you to think through and do some research if you are not able to answer the questions. But I wanted us to try and see if we know. And if we don't know, it means that we have some homework to do. But I want us to think through it. If you know it, then well and good.
If you click participants, you're able to see the attendees. Okay. I don't know if you.
And they can't talk, right? Is everybody okay? Can we proceed? Have you can somebody share if they've been able to answer these questions? Any
ladies, just put up your hand and I'll see it if you want to share with us.
Okay, hopefully everybody has tried that exercise. Why are my slides moving? Yeah, so why financial management? If you want to know that you're making a profit, you need finances. And that's the only way you can know how your business is doing. Yeah, Dorothy, that's encouraging that you're following. I was getting a little worried that I was alone. Finances also will guide you in making pertinent decisions. You're able to monitor the day-to-day running of the business. Someone was looking forward to learning how to monitor their finances. They will help you in pricing, supplier management, making decisions like diversification, getting out to new markets. And then they help with future projections. These future projections are very, very important because when you get to a stage when you want to look for sourcing of finance, they will want to know what the value of your company is. And usually the projections are made from your financials. So that is really key. My slides are moving slowly, but I think they will eventually move. Sorry, I can't move the slides. I'll stop share and then try share again.
Okay.
So the basics of we are going to look at the basics of financial management. So we shall be covering bookkeeping. It's one of the tools that you need as to create your financials. We shall be looking at financial statements. We shall be talking about projections, financial projections, and then financing sources. So those are the key things we are going to be looking at. So when I say bookkeeping, it means I'm talking about accounting records. Planning, that's also comes, your plans have to go into the numbers. Monitoring, internal control, all these are covered by the financials. And your hand is raised. And Namakula, please go ahead. Mary, can you let Anne say what she would like to say before I proceed?
Yes, I have allowed her to speak. Anne, go ahead.
So as we wait for Anne, the first tool, so I'll be sharing tools. You have to be disciplined for good financial management. So the first tool is the budgeting, the one I'm going to put up. And I've put a very, very simple budget. You have to work on a budget. So what you do, you write down all your expenses and all your revenue, or you budget for all your expenses. And that can be done in a very, very simple Excel sheet. Putting down your budgets, that's an example there, your rent, your utilities, everything that you're spending, putting a monthly budget and tracking the actual monthly expenses. It's a very, very simple tool, but it's foundational tool if you want to build good financial management practicing. So the first thing is, do you have a budget? And do you write it down monthly? And are you monitoring it? So I've worked with small businesses, startups, but I also sit on the board of big companies. And some of these practices, the big companies, they take them really, really seriously. And it's the same practices that you can also bring into your business and the same disciplines you need to have for you to grow. So the first discipline you should have is a budget. This also applies for personal financial management. You need to have a budget, a monthly budget, and be able to track it. January to December, budget against expenses. Then you do an analysis and find out what happened here? Why was I over? And that's the beginning of monitoring. So you first start by recording a budget and track it against actually what happened. And then the difference, you start monitoring the difference, and those differences now will inform you of your decisions going forward. It's a very, very simple tool. And I recommend that if you're not diligently doing a budget, because I know that many times we start budgets, but after some time you stop and you get overtaken by events. So that's I just put a sample there of a budgeting tool, which can be done in Excel for yourself. So the next one is definitely bookkeeping, because financial management, you have to have finances. So I'm going to just go through a few things that you need to do, to look out for your bookkeeping. So you can use a software, or you can use an accountant to help you with the bookkeeping. I'll be sharing a list of software, but also I think Mary has said she's an accountant. I'll let her in on what advice she has in terms of accounting. It is always advisable to, as a business, separate your account, personal account, from the business account. So have a separate business account as a start. Yeah, so that you're not mixing up monies. Reconcile your business account at least once a month. Do a reconciliation at least once a month. Track your sales on a daily. Track your sales on a daily. And deposit all the money from the sales into the account. Because if everything is being done via the account, then it is easy to go back and track and have accountability. Even for your expenses, checks are better than using cash, but these days we have mobile money, which is also very good at helping us track. And you can print out your statement from your mobile money and be able to know what you spent. And then pay business expenses first, not yourself. Let's cater for the business expenses first. Pay yourself at the end by writing a check out of the business. So when we go into your account, your bank account, we can see a transaction paying you. So those are very basic steps that if you're not doing yet, you need to ensure that you have them, because if you don't have these basic things in place, then you will not be able to. It will follow through your entire financials if you don't have the basics right. So there are software packages and that can help to do some of the things I've talked about in the previous slide. There's QuickBooks, there's TurboCash, Admin, QuickFile. There's one called Wave, and some of them are online. But I would like to call upon Mary to say something about these software packages, the market. And for example, if I have no access to a software package, how will the accountant help me to set up those basics? Mary, please share with us as an accountant.
Sorry, Annette, what do you want me to share?
To explain to if I come to you, for example, yes. I've talked about software packages, but I might not know which software package to go to. And I'm assuming if I come to you as an accountant, you can help me, at least for the first time, to set up. And
okay,
then I can continue monitoring
in terms of software packages on this market, we have had for a while now tried and tested QuickBooks and Tally, and these are good for small businesses. Recently, we have Wave, but Wave has stopped operations in Africa, so they've asked everyone to move to Zoho Books. For things like Wave and Zoho Books, you don't need to download anything. You don't need a setup file. So it's all cloud-based, and so it depends on what business you have. Some are more used. The web-based ones are better for non-accountants. Sorry, the internet-based ones are better for non-accountants because they're easy to use. Things like QuickBooks, you may need someone to come in once in a while to check that you're putting the things where they should be. But what I always say is, even if you don't have a software package, a simple Excel sheet, if you record every little thing, if your bookkeeping is organized and in order, an accountant can pick it up. And then whatever they use after that will not even matter, because they'll be able to put information together and produce financial statements for you. So it all goes back to what you were saying about bookkeeping. Record every single thing, everything. Even the border guy.
I knew as an accountant you'd explain it better. So that is the foundation. Those are the basics. And I think if you're having trouble for the first time, I think you can approach Mary and she would support you, I'm sure, at a fee. But the other thing I wanted to talk to you as entrepreneurs, please do not hesitate to invest in having good financial management practices, or to invest in using experts in terms of helping you. Yeah, Anne's hand is still up. I'm not sure whether she still wants to talk.
I'm also not sure. Maybe it's up by mistake.
Okay, I'm trying to move my slides as well. Sorry, they're a bit slow. Any questions in the meantime? As I try to maneuver the slide with the slides.
Roslyn is asking how she can use technology to increase sales or customer base. She runs a small timber business worth 11 million. I think that's outside Annette's scope, but over to you. You think you can speak to that?
She wants to use technology to increase her sales. I think there are also
customer base.
I think there's different ways you can do it. Like Maria said, it's really outside my scope. But there's different ways that you can do it. There was a customer service thing run last week, probably. Let me try sharing screen again. I apologize for that, but my slides are not moving. I'm not sure why that is. Sorry, I'm not able to move the slideshow. So this was the next slide. I want to talk about the accounting cycle. Because we're talking about bookkeeping, you might not be clear. The accounting cycle starts from the transaction.
Please expand it.
Sorry?
Just expand your screen. Maximize your screen. It's too small.
I think it was maximized. Now I've lost it. The slideshow is not moving, so. Is that a bit better? Okay. So the accounting cycle starts from the transaction, and you go through doing journal entries, trial balance, worksheets, adjusting entries, and you get to the financial statements. So this part, from the transactions all around to adjusting entries, that is what the software can do for you, to the point where they produce your financial statements. So you can either use an accountant to help you, or have someone help you through the accounting cycle. But for purposes of this session, I'm going to focus on the financial statements. As an entrepreneur, you need to be able to interpret your financial statements and to make decisions around the financial statement. So this is the end result of the whole accounting cycle. And like I said, we're not going to go through accounting, the journals and how that works, and the trial balance. Because honestly, I've done accounts. You need a professional to help you do that, or you need to use an accounting system to go through that place, to the point where they produce for you the financial statements. So we'll be focusing on financial statements and how to interpret them and what to look out for in the financial statements as an entrepreneur. This is how this links you to funding. If you're looking for funding, if you're looking to grow your business, the financial statements are the ones you look at actually. So from your transaction, from the bookkeeping, my recommendation is you get a software to help you track, or you get an accountant to work with you until you are able to get the financial statements. Do we have any questions up to this point in time? Okay, if there are no questions, we'll proceed to the next session, which is now going to look at the different set of financials, like I've said. So there are mainly three sets of financials. There's the balance sheet, the income statement, sometimes called the profit and loss, and the cash flow statement. So I'm going to go through each of those, the uses, what to look out for. But as an entrepreneur, you need to be on top of your set of financials. And at the beginning, when I mentioned that you need to tell your story through your financials, this is where this is what shows the state of affairs of your business. And you need to be able to articulate yourself and your financials, especially if you're going to go to a bank for money, if you're going to speak to an investor for money, or even if you're going to plan and decide, do I want to expand? Should I close my business? You have to have this on top on your fingertips. So the first one is the balance sheet. I think you must have heard about it quite a bit of times, but it's divided into three parts. It has the company assets, the company liabilities, and the equity. The company asset is all the resources that your company owns. Those will come through in the balance sheet. The liabilities is what is owed. If you owe anybody, that should come through in the liabilities. And then equity is what you or your other shareholders have invested into the business to start it. If you're about to start a business, you're going to have some capital to start with. That is what we call the equity. And this one is always tracked on your balance sheet. We call it a balance sheet because it has to balance all the time. If it's not balancing, then there's something amiss. So what we have, what we owe, and what we are worth. Those are the three things that are tracked on the balance sheet. And the assets that the business owns should be equal to the liabilities and the net assets or owner's equity. If you add the liability and net asset and the net assets, this should be equal to the assets, and vice versa. So that's the balance sheet equation, which is normal, but you as an owner, you need to really look into your balance sheet. So I have an example there of a balance sheet, a sample. Like I said, if you look at the top, so you have your assets, and your assets are usually broken down into non-current assets or fixed assets and current assets. So you always have that part of assets. Then the next section is the equities and the liabilities. So the liabilities, your loans, your creditors, your payables, they all go under there. So your assets, which is 2.1 million there, have to always equal to the equity and liability, which is 2.1 million over there. This is prepared as at a particular date, usually at the end of the financial year. You'll have this prepared. If you've been doing your bookkeeping very well and tracking everything very well, you should have a balance sheet. When you need to do anything, you need to go to the bank for money. When you need to go for an investor to come and look at your business, this is one of the things they'll be looking at. And we'll go into a little bit of analysis of how you use this balance sheet to analyze how well your business is doing. So the uses, if you want to know your status at a point in time, working capital, because it shows you your current assets and your current liabilities. So working capital is the money that you need to use to use in the day-to-day running of your operations. The balance sheet is able to show you how you're doing. To provide interested parties in your business, to determine if you can pay a dividend. So it does a lot of things. So it's very, very important to have a balance sheet. The next one is the profit and loss statement. The profit and loss statement. And it has four main things. So you start, the profit and loss statement is now going to track your income. And it's going to track income you've made over a period, over a month, over 2 months, over a year. As opposed to the balance sheet, which is at a date, the income statements will track over a period of time. So your revenue or sales, you go into there, you need to know how much it costs you for those sales. And there's another slide that's going to show the breakdown of what that means. Then you get a gross profit, and here you remove your expenses, and then you get a net profit. So each of these statements has a different role it plays, and that's why we have all of them. And so you need to understand what is the role of the balance sheet, what is the role of the income statement. This is a further breakdown. Sales is always the first line in your income statement. And that's when you sell a product or a service, what you're paid, you book it as revenue. Then the cost of buying that product, of transporting that product, is what we call cost of goods sales, cost of goods sold, or cost of sales. So you book those into the P&L. All your expenses, this is where they're recorded. You remove them, and then you're able to get your net profit after that. So like you saw the balance sheet, it had only assets and liabilities. This one is actually capturing the expenses and the revenue that you have made. That's a sample income statement. Like you said, we said sales were there. In this case, you can see the sales have been recorded. The cost of goods have been recorded. All your expenses, any other income, and then you have the net income. That's what it looks like. I know we all know these things, but let's remind ourselves, because I'll be talking next. I'll be talking about how to analyze these statements. So what's the use of an income statement? This is the one that tells you if you have how profitable your business is. From the balance sheet, you will not tell about how profitable your business is. It will show you how the profit was made or how you made a loss. It will show you what you need to tweak to make a profit. The investor is very, very interested in this business, and also the lender is very interested in this statement. They want to see your profit. And it will help them make a decision. Is your business profitable or not? Both historical, they will be looking at your historical records and also your projections. I'm trying to move to the next slide.
Has it refused again?
Do we have any questions so far? I see people are asking for the slides. Yes, I'll be able to share the slides with you after the session.
Ladies, you can use the chat box or the Q&A tab to ask your questions, and Annette will answer them.
I apologize, the slides have hung again, but hopefully we'll manage. So yes, we've talked about the uses of this. Yeah, so we'll go to the cash flow statement. That's the third statement I shared with you. And this one is really, it tells us how well the business is doing in generating cash, and how well are you able to pay your debts, and how well are you able to service your expenses. So the cash flow is really about how much cash do you have. And please note, it is common for your business to be profitable but have no cash. And sometimes you can have cash and yet your business is not profitable. So those two statements have different roles, and you must look at all of them. So the cash flows, they will be capturing 3 different areas where your cash flows come from. So in a business, your cash flows can come from your operating activities. These are the day-to-day activities. If, for example, in the business of selling peanut butter, for example, the cash flows will be the money that's coming from selling that peanut butter. That's what we call operating activities. The business that you are in. If you're in the business of microfinance, your cash flows will be from the interest that you're earning from lending out that money. Then we have cash flow from investing activities. Because as a business, you can also invest in other activities. You can go and invest in treasury bills. If you have some excess cash, you can invest elsewhere. So that one is classified as cash flow from investing activities. And then there's cash flow from financing activities. This is when you borrow money, say from a bank. You borrow money. That means to finance your business. So you've gotten cash flow from borrowing. That one is classified as cash flow from financing activities. So your cash flow will be split into 3 parts, and it will be tracking how the cash flow is doing in the 3 parts. If you have a big cash flow and it's coming from investing activities or financing activities, and it's not coming from operating activities, then you might be having a problem there, because it means your core business is not generating cash. Cash is not coming out of your core business. That's why it's important to classify where your cash is coming from. You might now have just decided to put all your money in treasury bills, and your cash flow is looking good, and your operations are not doing well. Or you might be borrowing quite a bit of money, and all your cash is coming from borrowing, and your operations, nothing is coming through from your operations. So there's a problem there as well. So you need to go back and see, how can I make cash? So that's a statement. A cash flow statement looks like that. The first part there is the operations. The money you've paid from operations, you see it's in black, you add it, and then you remove all your expenses during the operations. The second part will capture investing activities, same thing, and whatever you spent in those activities, and financing activities. So begin to look at your cash flow statement and begin to analyze it and see, where is my cash coming from? As you can see in this particular one, investing activities, we are having a loss. That sector is having a loss. It's not a loss. The cash is negative, basically. We spent out much more than we received. And from
net outflow.
Yes. So yeah, so from this, the operations flow is really good. It's positive. The cash from operations, the cash flow from operations is doing really well. So that's how a sample cash flow looks like. So what do we use the cash flow statement for? To evaluate our cash position. We need to know where we are in terms of having cash. Like I said, you can be profitable, but not have any cash. So it's important to know. Then the cash flow statement is used a lot for future projections. And these projections are the ones that are used to value. So when you value your company or value your business, when you're looking for example, equity financing, the person who wants to come and put equity needs to know the value of your company. And you need also to be able to articulate the value of your company. So the cash flows are used to make future projections, which are then discounted to give you a value, which we call the net present value. It's very, very important. The income statement can also be used, depending on the type of business that you're in, to project and value your company. The cash flow will also help you to understand repayment capacity. For example, if you have loans and your cash flow doesn't look good, it means you're not going to be able to pay for those loans when they come up. It helps you to make your financial decisions, because if you look at your cash flow, then you can say, you know what, let's not buy this asset. Let's not spend on this, or let's spend on this, depending on how our cash is moving. And many people say it is the soul and heart of the business. You can imagine how, if you have a profitable business but no cash, you'll be stuck. You might not be able you might not even be able to pay back your loans. So those are the uses of the cash flow, and how we can have a discussion on how to create positive cash flow by going back and looking at the cash flow statement. If you reduce your expenses, you can create a positive cash flow. If you increase your items sold, the turnover, you can create positive cash flow. Pricing, you can do it by tweaking the pricing. You can now try and look at the timing of your expenses. If your cash flow is tight, you might decide to negotiate with your suppliers and pay in the next month or 2 months if cash flow is tight. You might now look at where else can I get cash from. You might decide not to pay yourself because your cash flow is tight. And it also helps you to establish your policies with your suppliers, with your customers, and be able to manage the cash flow. So the differences between the three statements, as I said, as an owner, you need to understand your financial statements, be able to interpret them, be able to know what they are saying. Don't leave it to the account person who's helping you with accounts and focus on only sales. You need to know your numbers. So I said the balance sheet is a statement at a specific date, while income statement and cash flow are periodic statements. If you want to know what the company owns, you go to the balance sheet. If you want to know how much a company has made, you go to the profit and loss. If you want to track changes in cash, you go to your cash flow statements. The income statement and cash flow can be used to value the business, as I said. In the balance sheet, you can tell how liquid your business is, and also the cash flow. And both of all these statements complement each other, because there's a figure on the income statement that will feed into the balance sheet. So they need each other and they complement each other. And you also need to understand how all the figures are flowing from one statement to the other. Because like I said, the lenders will want to know how leveraged is your business, how much have you borrowed, are you generating enough profit? They will come to these statements to look at them. So I would like to pause for questions, because I feel I've talked a lot. I don't want you to sleep in the finance class. I would like to pause for questions here. Ladies, are we together?
Have we been confused? Are we still on track? Do we need clarity? Raise your hand, post in the chat box or in the Q&A, and let's have Annette answer your questions. Just post a comment, just so we know you're there and you're listening.
And if you're okay, you can also say we're okay, we are following. I don't know, maybe they're unable to post. I'm not sure.
Enid says they're okay. Daphne is on track. They are there. There is a question from Stella. Should the financial statements be annually or can be half year or quarterly? Over
Actually,
to you,
they should be even monthly. We can do monthly management accounts so that they build onto each other. I think the more frequent you do them, the better. So start with the monthly ones.
I hope that answers you, Stella. Start with monthly statements and you build on them. At the end of the year, it will be very easy to even close the year. In a small business, Rosalind is asking, how do I make the profit and loss? I don't understand the question, Rosalind. Maybe you need to clarify. She asks, in a small business, how do I make the profit and loss?
I think, I'm not sure what Rosalind is asking, but the financials help you to know whether you're making a profit and loss. So it is your business that has to make the profit and loss. For them, there are tools to help you to know whether you're making it. So in the first place, are you doing your record keeping that we talked about? Are you recording your sales on a daily? If not, I recommended that you get the help of an accountant to show you how to start doing all those records that you require, or get a software system. There are simplified ones. There are some online that can help you track. And then you just press a button and it will tell you whether you have made a profit. I hope that answer is helpful.
I hope so too. Stella Kivila is asking, what is the normal growth path for business in terms of profit? She is in her 3rd year and they still have not posted a profit.
Stella, that would really depend on the type of business that you're doing, whether it is capital intensive. I've seen businesses even take 5 years without making profit yet, but they know their trajectory. So forecasts are important. The forecast of your business, how are they looking? Have you done forecasts for your business? And it would need a little bit of more work to understand what's going on, to know whether your business is having a problem or whether it is on the right track. But I cannot generalize that answer. There is no pattern because different industries behave differently. Some will start even making a profit on the first day.
That's true. Amazon only started recording a profit recently out of all the years they've been in existence, but that was a strategy that they set out. So profit is not the only indicator of business success. So Stella, like Annette said, that needs to be looked at more specifically. Thank you, Annette. Stella Mayanja is asking, how do we manage business with partnership in terms of sharing returns where we contribute at different capacities? For example, one more in operations than others in capital. There are 3 partners.
I think you would have to agree on a sharing ratio, but I would recommend, well, you have already started, but it would have been good if you had agreed even from the beginning and understood what everybody is bringing in. But it's a discussion you'll have to have, and which is agreeable to all the partners in terms of how you can share your profits. It's okay for somebody to put in money while the other person is putting in the operational work. That's also fine, and you can still be equal shareholders as well. But these things have to be agreed on before.
Thank you, Annette. Stella, the other thing also is sometimes the partner in operations should be paid a salary while the rest just get a share of profits. That's what usually happens in like accounting firms and law firms. Stella Kivila is adding to her question. She's saying, this is the one who has been in business for 3 years and they haven't posted a profit. They have outsourced the finance function to an accounts firm. What questions should they ask to keep them accountable?
Stella, I need you to be very attentive in the financial statements we've just gone through, because that is where you're going to ask the questions once you understand those financials. So when they come to you, once you understand your financials, what's my cash flow from operations looking like, the profits, the income statement, you having a good understanding of them will help you ask them a number of questions. But then you also outsourcing is good, but you need to have an understanding, because they help you have insight into your business. For example, you have not made profit, this is the 3rd year. If you analyze your financial statements, you will start to see some trends in there. So ask them for trend analysis of your how your business has performed. That question that you have just been asking, or we have not made a profit now, I think it's a good conversation to have with your finance firm that you've outsourced to. And also, I hope they are also doing projections for you, because with your projections, you can have hope on when you will make profit and what you need to do to turn around. So I think it's a good thing you've done, but I urge you to understand how the financials work so that you can have a beneficial conversation with them. Okay.
Thank you, Annette. The questions are still there. Roslyn wants to know how she can generate these using her sales and purchases data that she has.
Generate the statements?
Yes.
I think the sales data should be able to feed into the revenue, which goes to the income statement, because your sales data times the pricing of those sales is what gives you revenue. So the data from your sales and the revenue should feeds into the sales data times price feeds into the revenue. So that would feed into your income statement. But also if you're using a software, if you feed in your sales data, automatically it will generate all these statements for you as well. So have a look at some of the softwares that have been talked about, but that's where sales, did she ask sales and what else?
How can she generate these statements using her sales and purchases data?
So sales and purchases data will only talk to your income statement, because I think that's where your cost of goods will be, which will be your purchases, and some of it might be in your expenses. So those items are just single lines in the income statement. You need many more items to fill up your whole income statement. Those are just two things that will go into your income statement. So you need more than sales and purchases data.
She needs to talk to a professional, I think. Stella, it's hard to build a business. How should an entrepreneur benefit from this business? How should we structure for this benefit? How should an entrepreneur benefit from this business, and how should we structure for this benefit?
I'll try and answer it. I haven't understood the question really well, but I think as an entrepreneur, it is your baby. You have the vision for it, and most entrepreneurs are patient because the starting up period can be very, very hard. So you have to be patient, but you have to be clear on your vision. What do you want to do?
I think she clarifies. She says in this question, she means, what should we do? Low salary, high dividends, or the reverse? How should the entrepreneur pay themselves?
Okay, there are different ways that entrepreneurs can pay themselves, but if your business is not yet making money, as you stated, I don't think it's time yet for you to get paid yet, because if you're not making a profit, it's highly unlikely that you'll be able to pay the dividends yet. So
because dividends are paid out of profits.
Yes, dividends are paid out of profits, so you will not be able to do that yet. And for the salary, if you are not employed by the business, I don't think you can. If you're in as a shareholder, your payment comes as dividends. If you're in as an employee, that's when you can get a salary. I think it relates to the question that was asked earlier. If one of us is in operations and the others are shareholders, have brought in capital, how do we do? I think Mary suggested one of the ways is you can pay the person in operations a salary. So a salary, if you're doing actual operational work, that could be considered. And then the shareholders will have to wait for when the company makes a profit to get dividends.
Question, what is the ideal balance? What is the ideal balance? Is the ideal that cash flow should be positive at all times, even if the profit and loss is negative?
I think cash flow should always be positive. You have to survive, otherwise you won't be able to pay for anything. And many companies make negative profits for a while, and eventually the business will start making profits. But you have to have your business plan right. You have to know, you have to understand why you're making losses at the moment. Is it temporary or not? But it is okay to have a loss, at times. But positive cash flow is essential for the day-to-day running of the business. Otherwise, you won't be able to pay salaries. You won't be able to pay for your expenses in the business. So yeah,
Stella is saying it's painful.
Profit can be negative.
Stella is saying it's painful to pay everyone else apart from you, yet you have invested highly. Stella, if you're working with those people, pay yourself also. Because that pain of paying other people when you're not earning will be real. Pay yourself if you're also working. But if you're not working in that business, wait to make a profit, and then you will earn dividends.
So Stella, I'll give an example of the private equity market. The venture capitalists, when they come in and they buy your idea, and for the business to run and the operations to go, they will invest their money, but that money is needed for that idea to come to life. And they have to pay the people who are making that idea come to life. So the people who are working will have to get paid. Otherwise, that idea will never come to life. And you, as an investor who has put in your money, you're confident of your vision after 7 years that you'll attain your vision and you'll be able to get paid back. So I advise you as an investor or an entrepreneur who's not running in the business to ensure that your eyes are on the business. That's why I was saying be on top of your financial statements to make sure that the right things are being done in the business, so that in the end you don't lose your money. This is your interest to know that to ensure that that business becomes successful. That's how I would advise you, Stella. Be very keen on how the business is working, attend those board meetings, look at those numbers, ensure that it's on the right track so that you eventually get your money out.
Gloria is asking for guidance on simple accounting software that can be got online.
I think we had, maybe she came in late. Mary, we gave her a list earlier. In the there were things. Wave has stopped working. I think Mary said Zoho books. There was a whole list up there, QuickBooks, a number of them. When we share the presentation, you'll be able to see the slide because it was a slide earlier. So if you don't mind, we can proceed to the next.
Let's continue.
So once you have those financial statements and you know them, so there are many things that can be done. Obviously, I won't go into detail, but some of the tools we use in financial analysis to find out how your business is doing, I'll just share with you a few ratios that we use to measure. And I would want you as entrepreneurs to know some of these ratios. There are very, very many. I just picked out a few of the ratios. We have what we call the profitability ratios. These ones will help you to find out if your company is profitable or not. There's a measure. The first one is called, I picked out only 3, but there are many more. There's the gross profit margin. So this is the gross profit, you divide it by the revenue, and it will give you a ratio. The higher that ratio is, the better you are doing. So it's good to track this, say maybe on a monthly or quarterly basis. So the gross profit and revenue, these figures are both in the income statement that we looked at, the profit and loss statement that we looked at. So you can calculate the gross profit margin. When your accountant, Stella, when your accountant brings your financials, ask him what the gross profit margin is, and compare it to your gross profit margin last month or last year, and see whether you are improving. There's one we call the operating profit margin. Operating profit is also in the income statement. You divide that by revenue, it also gives you a number. And you can also get net profit margin, net income over revenue. So you have a ratio that you can compare over time or from period to period to find out whether you're improving or you're not improving. And then this will trigger you into thinking of what is the problem here, or what are we doing well? What can we do better? So that's how you use the profitability ratios to analyze your financial statements. Then another set of ratios is called the liquidity ratios. These ones are to show you how liquid you are, how liquid your business is in the short run. We have what we call the current ratio. The current ratio is the current assets you divide by the current liability. So this figure now is from the balance sheet. So the balance sheet will help you in determining how liquid you are. You just divide current assets over current liabilities. The quick ratio or the asset test ratio is you only consider assets that are very, very liquid. So from the current assets, you remove the stock and you divide by the current liabilities. Then it also gives you a ratio to compare and see the health of your business. These ratios help you with a health check. And the cash ratio is the net income over the revenue. And this cash ratio comes from the income statements. So you can see which statement the ratio comes from by what's in the ratio. So somebody was asking about the practicability of the statements. One of the ways is this analysis. When you get your statements, run these ratios through and find out the health of your business. How is it doing? Profitability, how are we doing? Because a number like, I've made a profit of 1 million, it doesn't tell you anything, whether it is good or bad. Or I made a profit of 1 million last month. The ratios put it more in perspective. On the revenue you have made, how much profit did you make? So as a ratio, if maybe your ratio was 20% and it's on the low side and you want to work towards 30%, then you start adjusting your business accordingly. We have the solvency ratios. These ones will show you how indebted you are, how your debt position is. So there is a debt to equity ratio, there's a debt to assets ratio that will show you according to the equity you put into your business and according to how much you've borrowed, what is the ratio? How are you doing? Are you doing well? Are you over borrowed? And obviously the lower the debt to equity ratio, the better. Because very high debt levels are not for the business. We have what we call return on investment. This is also the ratio that shows you on the return compared to how much money you put into your business. And for the entrepreneurs who are eagerly waiting to be paid, this is a good ratio for you to try and calculate and see what return are you getting on that investment that you made into this business, and then comparing it with other returns. You can even compare it to if I had put my money in the bank, or if I had put my money in a unit trust or in a bond. What is the return on this investment compared to other returns where I would have put my money elsewhere? So it helps you to compare other uses that your funds could have gone to other than your business. So I have an exercise. I would like us to calculate the gross profit margin from our income statement. I'll just go back up to it. We said gross profit margin was gross profit over revenue. Just to test yourselves. It's very easy math on a Saturday afternoon. So there it is. Are we able to calculate the gross profit margin and the net profit margin from that statement? I forgot to ask you to come with calculators, but you can use your phones because it's simple math. A little practice so that when you go to look at your financials, when you go back, you'll be able to calculate your gross profit margin and your net profit margin. 1 minute to try it out as I get myself a glass of water.
What is revenue?
It is that figure up there, sales.
Oh, yes.
Yes. Yeah, I'm sure we got all that answer right. I'm sure we all got it right. So from the balance sheet, I wanted us to calculate the current ratio. So I'll go back to the balance sheet so that we can look out for the current ratio. That's the balance sheet. Are you able to pick out what the current ratio is? Current assets divided by current liability. The rule of thumb is that a current ratio of 1 is like normal. So you want your current ratio to be greater than 1. It means you have enough to pay off liabilities in the short term. If you calculate your current ratio and it's greater than 1, you're doing good. If you calculate the current ratio and it's less than 1, then you need to do something. It's an alarm telling you to look into your assets and liabilities. And looking at this statement, we are looking at the current ratio. To me, looks like it's less than 1. So it wouldn't be it's not in a healthy position. If the current ratio is below 1, so this business would have to think hard about how to manage the current assets and liabilities, and maybe how to reduce on the liabilities because it has a current ratio less than 1.
We have some answers in the chat box. I want you to agree or disagree and take us through. Gross profit of 25%.
Was that the answer, Mary?
I got 40%.
Oh my goodness, I hadn't calculated. The answers are different. Let me go back. I thought we'd all get the same answer. That was gross profit margin.
Yes. So you have 400,000 over 1 million.
Yes, that should be correct. Ladies, it's 400,000 over 1 million. That's the gross profit margin. And the net profit margin is 178,400 over 1 million. Okay? Redo your calculation. Gross profit margin is the 400 gross profit divided by the sales, which is revenue, 1 million. Don't worry, you'll have the slides, so you can always go back and practice on your balance sheets and on your financials.
And the current ratio?
Current assets over liabilities.
Over current liabilities.
Where is the balance sheet? So the current assets we have, you have to total up those 3, which is 10,000.
I think it's that 10,000.
Yes, divided by the 20,000 current liabilities,
which is 0.5.
Yes, which is less than 1. So like I said, it's not a good position because it's less than 1.
So Stella had asked if there are any industry benchmarks. They are there for a few things. For example, like Annette is saying, the current ratio should never go below 1. For gross profit margin, different businesses aim for different margins. So if you aim to get, I don't know, 50%, and now you're at 40, then you will know that you haven't hit the target of where you wanted to be.
Yeah, so the whole objective is to know how to analyze your accounts. And then once you know how to analyze your accounts, then you'll now be able to find out what is your industry. What does your industry look like in terms of gross profit margin, current ratio, debt to equity? So you expand it. And if you do enough research, you'll find these things. Some industries even publish their accounts. So you can find them and compare. So this exercise really is to make us aware of the different ways we can analyze our financial statements. First of all, to understand our financial statements, and then also be able to analyze them and compare them with our industry. Okay. Okay, thank you. That was just a quick, a short one to get us thinking through the ratios. Thank you for those who have responded. Yeah, I'll share screen again. So now we are going to move into, if there are no further questions, we're going to now move into the last part, which is about financing our businesses. There are different types of financing that you can get for your business. I think there were quite a few questions on how to financing the business. But once you have built up your financials, you've done your bookkeeping, you run your financials, now you have your monthly financials, annual financials, quarterly financials, then now those are the basics that you need to now start approaching people in terms of financing. So we know debt financing, it's really the loans. Yeah, they come in different forms: bank loans, overdrafts, credit cards. We have a lot of loan sharks. You can get equipment leasing, hire purchase. You can borrow from friends and family. We have a lot of lenders in the region, in Nairobi, in Kampala. We have a lot of people who are lending. All that is called debt financing. The bigger lenders, like the banks, the more organized lenders, will ask you for, they will want to look at your financials before they can lend you money. They will have to, financials will be one of the main things they'll be looking at. And so I have shown you the financials as at that date, but there is what we call the projections, projecting your financials for the next, say, 5 years or the next 3 years. So people who are lending money to you will want to look at your forecasts. So Stella, that's one of the things you can ask the people you have outsourced your finance to help you come up with forecasts for the next 5 years. Or if you have a business plan for your next 5 years, it has to be having financials matched to it. And that's a whole different exercise when it comes to forecasting. We have what we call financial modeling. The financial modelers can get your business plan and help you do forecasts for going forward. So banks will want to see your past 3 years of annual financials, but it will be also important to show your forecast so that they can know what you're going to use your money for. Yeah. So if you opt for debt financing, if you opt to borrowing, you maintain your ownership. That's one of the advantages of borrowing. You're still the entrepreneur. You're just borrowing. You're going to pay these guys back. And then the loans are tax deductible. What this means is that the loans, you can account for the loans in your financials before tax is applied. So that's what they mean by tax deductible. So it's an advantage, as opposed to we'll look at equity, whereby the dividends are paid after tax. So you benefit because that expense of the loans will be removed before you get taxed. So you'll be taxed on a smaller amount. And then you don't need to share profits. I mean, debt financing is straightforward. You agree on a debt, you pay back, there are no ties. So the disadvantages, it may not be easy to access. You need to be sure that you'll be able to pay all those repayments or consistently. That if you don't pay, it could affect your credit rating. You have to be committed. Your cash flow actually has to be on point. It could lead to bankruptcy if you don't pay up in time. That's the disadvantage. And of course, some loans are collateralized loans. Sometimes you can have loans. There are different types of loans. So maybe I'll wait to hear in the Q&A the questions that you might have around debt financing. How do you attract debt financing? What do you need to do? again, we're going back to your financials have to be in place. They have to be in place. You have to show what you've been doing in the past. You have to have a good track record of paying and repaying. The more you borrow and pay on time, the better your record becomes, and it gets easier to access loans. You have to have a good business plan, and then you have to be able to articulate your business growth to the person who's lending you the money. If you go to the bank, you need to be able to articulate your business, why you want the money, what it's going to buy, and how that whatever you're going to buy is going to generate you a profit. So the next one is equity financing, and equity also comes in different forms. It's your personal money. First of all, when you start as an entrepreneur, that money that you put in is equity. That's what the one we record in the balance sheet. But then you also have your sweat equity. You're the entrepreneur, you're the one who's working, doing everything. They normally call that sweat equity. We have venture capital and angel investors. They're very similar, but angel investors come to who still have ideas, and they help you bring your idea into real life. Venture capitals will come in when you already have your business, and they want to own, they invest in your put money as investors. They also become shareholders. These days we have a lot of crowdfunding where people come together and raise money for a project or a purpose. I have seen it also actually working online. Online is become a big thing. I think in the US, so much crowdfunding that project, even in Uganda and here in Kenya. And then we have, of course, the initial public offering, which is now a company that has really grown big and wants to now raise money from the public. So there are different types of equity funding. So equity is less risky than debt because really you don't have monthly payments to make. Whoever has invested in your business has to be patient. And I think that's why I told Stella she needs to be patient as an entrepreneur because she has put in the money. So we have to wait for the process. So instead of the cash being used to pay back a loan, the investors are patient. They allow you to reinvest that cash into the operations, so that cash can help the business grow bigger. Yeah, usually there are people who come and invest in your company and put in equity. They normally invest in companies, their expertise. So they come in and also help you to restructure your business and help your business work better. So it comes with an advantage. And then it's an opportunity for you to be part of a bigger thing. If I'm struggling with my business and I'm able to get a shareholder who's going to come in and bring in skills and also bring in money, it's an opportunity for me to be part of a bigger business, sticking to my small business with my few resources. So the disadvantage is that you have to give up a portion of the ownership. You're not the only one anymore, but I find that fine, it's okay. Then most times the equity investors will want to have some control of your operations. They will be nosy. They won't be like the lender who will give you the money and just wait for his payments. These ones will come and want to understand how it works, what are your governance structures, and all that. There's no tax shield, as I explained earlier. And the investors may ask for a high rate of return, which is fair enough as well. And the due diligence process is really, really lengthy. By the time somebody comes and analyzes your business and wants to put in money. So those are the types, but you can also, there's a slide up there where it was talking about working capital. That is more of the reason why you want to borrow. You can borrow because maybe you want to your cash flow from operations is struggling. So you need money for working capital. Banks also offer loans for that, just working capital. But you can also borrow if you want to buy like a fixed asset, an asset that's going to help your business. So you need to understand what exactly do you need the money that you want to borrow for. I would like to take some questions here in terms of financing, how to attract equity financing, same thing, a business plan with a financial model. Governance and management structures have to be very strong, be able to articulate your business model, great track record, and then you need to know the value of your business. The valuation is part of the finance. That would have been the next step, but it would need like a whole lesson in terms of how to value your company, but it's very, very important to know the value of your company. And I would recommend that you get an expert if you are at the level whereby maybe you want to bring in a new shareholder or you want to merge with another business. It's always important for both businesses to know their values before they can merge, or to know your value before you allow in a new shareholder to come in. It's really, really important. I would like to take some questions here.
Thank you, Annette. It has started raining where I am. I'm not sure, I don't have echoes, or you guys can still hear me. Annette, can you hear me well?
Yes, I can hear you well, very clear.
Okay, there is a question. Is venture capital strictly for profit organizations?
Not necessarily. It depends on your business idea, really. Do you mean that is it for companies that are making a profit?
Yes, okay. Is it only for profit, or even non-profit organizations can get venture capital?
I highly doubt that. I highly doubt that the venture capital will want to go into a non-profit, because the venture capitalists come to make money. They want a return on investments.
They come to make money.
Yes. So if you're a non-profit, that will not attract a venture capitalist, because for them they are looking to put their money where they can get more money. That's it.
Okay,
so it wouldn't
part of
work
financing.
for a non-profit.
I think Dorothy gets it. Venture capitalists are money makers. They want a return on investment, which NGOs wouldn't give them. There is a question here. Part of financing is the owner's money. Can we get paid back like any other form of financing?
I think I'll take that question. The owner's money, once you put money in the business, you get paid through dividends. And in the financial statements, you always see a line for where dividends are. So depending on how the business has performed, if the company decides to declare a dividend, then you will get paid through a dividend. So
but you can't get your capital back.
Sorry?
Can you get your capital back?
To get your capital back, you will have to exit the business probably to get your capital back. So that's a whole other discussion if you want to get your capital back. But if you're invested in a business, you will get, as an owner or shareholder, the payment mode is dividends. To get your capital back, it's a whole other discussion with that company. And there are many different ways of how that is done. They might ask for a replacement shareholder. They might ask you to get somebody to replace you. That would be a separate discussion between you and that company. But otherwise, the payment process is dividend. And remember, these companies are supposed to be going concerns. They're supposed to live forever. So you should be able to get dividends every time a dividend is declared forever.
Okay, if I attract a shareholder, how do I secure myself so that I'm not bought out?
That also depends on the situation, but normally you have contracts and terms and agreements and exit clauses that you sign for before you take on like a new shareholder. So you make sure that that is ring fenced very well. Your legal documentation. If you require protection, make sure you have done a very good job with the legal work in terms of you getting bought out. However, in more advanced companies and economies, you have what they even call forced takeovers. whereby people come and just, people take over, another shareholder takes over your company, and in the corporate finance world. But for our size of businesses where we are now, that's not really applicable. It's more of how we negotiate with each other. And just to be sure, in the agreements you sign, ensure that you have protected yourself.
How about maybe you just never sell more than 50% of your business?
That's one of the ways. That's one of the ways, so that you always remain with you remain the majority shareholder. That's one of the ways of protecting yourself.
Does profit always have to be the same percentage of your shareholding if partners have different shareholding? I don't understand the question. It's in the Q&A. Does profit always have to be the same percentage of your shareholding if partners have different shareholding? I think this speaks to profit sharing. Do you get profit in the same percentage as your shareholding?
Yeah, that's what it should be. If I have 10%, I should get 10%. If the other one has 50, they should get 50. And the reasons that they're having more shareholding is probably because they put in more money than me. So that should be okay.
Okay, I don't have any more questions. You can proceed.
Thank you, Mary. This is actually the last slide. I'm about to release you ladies. I'm told it's raining. So what are some of the do's and don'ts for a small business? It's good to invest your own money if you can. You have to earn your right to borrow. I talked about track record. If you're a new business, it might be difficult the first time, but if you maintain a good track record, you earn your right to borrow, and people will be looking to lend to you because of your track record, as opposed to you looking. Understand your financial statements. That is a very, very big fundamental to be able to have good financial management practices, because then you will know what you need to have in place. You'll know what to ask your accountants. You'll know how to negotiate with investors interested in your business. You know how to negotiate with the banks. You will know what type of loan to go for. Then you have to show profitability. It's important. Initially, you might not make profit, but it's important that you start showing profitability at some point in time. That will show that your business is on a good trajectory. It's good to monitor your working capital. Very, very important, because you want to keep your business in operations. So you need to be on top of your working capital. Try and be lean on fixed assets. Don't invest too much. Avoid the fixed assets you can avoid. And technology has really helped us in terms of cutting costs. So try and be lean on fixed assets. Think through what you really need for your business, because the fixed assets tie up money that you can use in your working capital. So look at that part. Match the sources and uses of funds. So if you're going to borrow, be very careful, because there are long-term loans and there are short-term loans and these working capital loans. So be careful as you take up a loan. Is it matching your needs? If you're borrowing for 5 years, if you need a long-term investment, try and borrow a longer date. Because if you're borrowing for something that's going to return your money in 5 years, and you take a very short-term loan and you start paying interest upfront, that is going to strain you. It's going to strain your cash flow. So match the sources and uses of your funds. If you need money for a 10-year program, maybe you look into an equity investor who's patient, who can give you patient money, as opposed to going to a very short-term loan. Shop around for your financing. Shop around. There's very many different options around. So do not rush to tie yourself to a financing decision that won't work for you. And get expert advice. if you can. I encourage businesses to look at experts as an investment, not as an expense, so that you get your thing right. Like I said, if your financials are not in good order, at least invest time with an accountant to help you initially to ensure that you're on the right track. And then maybe from there, you can continue using software. But for the initial, try get an accountant to help you. And then when it comes to now your financial statements and the sourcing finance, building financial models and your business plans, also try and get an expert to get you to invest. Look at it as an investment and not an expense. So those are some of my do's and don'ts of small businesses. And it is the last slide. I'm happy to take any other questions that are not related, that maybe areas I haven't touched. This is the time we can discuss that now. If you have a question on finance that you'd like to ask on financial management. Thank you.
Bella has a follow-up on the question of profit share. She says, what if the partners are putting in 50% in operational costs, yet they have different shareholding and so they get different profits?
Maybe Bella will have to put on her mic and explain further, because what does she mean that they are putting 50 in operational costs? I haven't gotten that part.
Bella, do you want to voice your question?
Yes. Hello, good afternoon.
Okay. Good afternoon.
Yeah, my question is, if you have two partners and one has a majority shareholding, say 60% and the other has 40, but in the business, they're both contributing 50-50 for operational costs. So, and then when it comes to profit sharing, does that mean then it's still 60-40?
Okay, I think Bella, the what's I'm not getting clear is so the partners are still putting in money directly
for operational costs. The business is running, and for example, you need to buy, say if it's an agriculture project, you need to buy feeds, costs like those which require day-to-day expenses. And the business is still growing, it's very young. So it requires you to first put in more money before you actually see the profit. So when you finally start seeing the profits and yet you have been contributing 50-50, does that profit sharing still follow the shareholding rule?
I think the challenge I see there is the contribution is being made as costs. The 50-50 contribution is coming in directly into the business to cater for the costs. But I wouldn't advise that money to be captured as a cost. It should be coming in at shareholder level. That's why you're having a challenge, because the funds are coming in at they're being captured directly in the business. So at that point, you should be capturing them maybe as loans to the business from the shareholders, which is a very different transaction from the shareholding.
Okay, so if they're considered loans, then it means every shareholder then gets paid back exactly how much they put in.
Yeah, these two transactions are different, Bella. The shareholding transaction and this 50-50 that is being put in, they are two different transactions. So my advice is that 50-50 be considered a loan and their loans paid back to the owners when the business can pay them back. The shareholding structure is different. Those ones will still be paid at dividend level at 60-40.
Okay.
Once the business makes profits. So you shouldn't mix the two up because they are two different transactions. And on the 50-50, which is being put in for cost, there's other ways you could have looked at it as well. It could also have still come in at shareholder level so that it doesn't.
Additional capital contribution. Right?
Sorry?
Would it be considered as an additional capital contribution?
Yes, that's the second
and
way.
therefore it would still contribute to the 60-40.
Exactly.
Or it would alter that.
So there is two ways that money could have come in as in additional capital contribution. In that case, at shareholder level, then you adjust your shareholder, contributions accordingly. But if it's already coming in directly into the business, I advise you take it as a loan, because you cannot you cannot bring it in directly into the business to cover costs. That means they are lending money to the business. So you need to review that, Bella.
Okay, and then, but what if, because the dividends I know usually are shared out annually. So does it mean you have to wait until the end of the year to, pull out these dividends? What if it's, can that change maybe quarterly or monthly?
Dividends are usually annual payments.
Yeah.
Annual payments after you have assessed the business performance after a year, and the shareholders, they have agreed to pay a dividend, because sometimes the shareholders decide we're not paying a dividend this year because we have to buy a machine, so we are going to reinvest the business into the business. So it's an annual payment, and shareholders have to agree to pay it. So if they agree no dividend this year, even that year you can miss a dividend. So they are not monthly. They can only be declared after the audited financial statement and the financial year has closed. So you have to wait for a year to be paid a dividend.
Okay, so in that case, if there is money that, for example, that the partner needs on a monthly basis, and that could be taken out, can that be taken out maybe as a payout? Because sometimes there's scenarios where a partner doesn't want to wait until the end of the year.
So for that one, I would recommend you structure. I think we spoke about it earlier. You can structure it as maybe a salary to the partner if they're involved in the operations of the business, and then you agree to pay them a salary if that's the money is for the work is doing for the organization.
Okay, then yeah, that's clear.
They could be paid a salary, which is an expense to the business. So that is different from the dividend side. So because dividend is for shareholders, and those ones have to wait at the end of the year when the business has made a profit. But if this partner is involved in the day-to-day operations and needs to get paid for his sweat that he's putting in, then you'd have to structure a salary for them.
Okay, thank you. That's clear.
Okay.
Apologies, the internet threw me out. I'm back.
Welcome back.
What are the best sectors or industries to invest into equity? Did you get that, Annette?
No, I didn't get it.
What are the best sectors or industries to invest into equity?
What companies should we be buying? As an equity investor, or?
In what companies should we be buying shares?
Okay, on the equity market.
Yes.
Okay, I'm not sure which market you're looking at, the Ugandan market or the Kenyan. There are many stock exchanges or international. Well, I had not prepared myself really in terms of analyzing companies on the stock exchange to advise which ones, but it depends on what you're looking for. As an equity investor, you have to be a long-term investor. As you can see, some of the companies that are on the Ugandan market have not, the share price has not even recovered at IPO levels. The price went down and has not yet recovered. So it really depends at the point in time in which you're going to invest. And I would need further analysis to see currently what's happening so that I can advise you on that. But I know that over the years, Safaricom has been a very good stock. In the first 5 years, you could have said that it was a very bad stock because it traded lower than initial price for a very, very long time. for almost 5 years. And then after 5 years, it started going high, and it has really gone up consistently over time. And considering that the way the world is moving towards technology and mobile sector, I think it's a good stock to buy, but sometimes it is up and down. So it depends at what point you're going to enter. So you need analysis as at when you're ready to buy a stock, because I can tell you something this week, and then next year it will be something else, or next month it will be something else. The stock markets are always up and down. What I would tell you is to go into the stock market, it's very good for patient, long-term investors. If you're going to go in over time, you put in your money and wait it out. It's not equity is not a market you need to jump in and out unless you're an equity trader. But for an equity investor, you need to be able to wait, because the markets are volatile, and anything they're very, very volatile and sensitive. Anything small affects them. Like I might be saying Safaricom has been a good stock, but remember, Kenya is going to an election year. So something like elections can affect it, and yet the company itself is doing well. So I can't give you a straight answer there, but I hope my general advice is helpful.
Okay, thank you, Annette. I think it is, because stocks are indeed very volatile and long term. I would like to sell my business in the next few years. How should I start tracking the valuation?
Yeah, hi, Stella. You need to do a valuation for your business right now if you want to sell it in a few years, so that and if you want to sell it in a few years, you need to start looking for potential buyers now, because these transactions usually take quite a bit of time. They're not overnight transactions. So you need a business plan, say a 5-year business plan, to show how your business will be doing in the next 5 years. Remember, somebody buying your business is buying your future. So you need projected future cash flows, which will be used to give a valuation now of how your business is doing. So I think you'll have to get a professional person to help you do a valuation for your business. And really, for someone to buy your business, it is really the story that you have and putting it into numbers, into those cash flows. And then you start looking around for potential buyers. So now is the time.
Okay, I have 4 friends who have been assets to the start of my business. They're all asking for shareholding. How do I respond to this? I personally feel we are too many, yet I plan to get some equity. Won't we be too many? Justin is asking. Justina.
No, I think it's an advantage and a disadvantage. Because for you to, are you just going to give them equity for free? I think you should put a price to that equity, so that the more you are, the more capital you have for your business. So it's a good thing. If you have 4 friends and everybody is bringing in 20 million shillings, then you have 80 million shillings to start your business. That's what how I would advise you to look at it. But also, you need to look at other dynamics like synergies. Are they people you get along? What skills are they bringing into your business? So you look at the capital they can bring in, but also look at the team dynamics. We need to work. Can you work together? And what aspects are each of those 4 friends bringing onto the table? So do that analysis. Then you decide if you need them. Don't really think about the number. Think about the capital. Think about the aspects, the unique aspects they will add to the business, and then think about the team dynamics of the 4 of you.
Thank you, Annette. I hope that answers Justina. I don't have any further questions for you.
Lady, any questions? That was the last slide for me. And in the beginning, we asked about our expectations. I tried to write some of them down. And I think I couldn't answer all of them. Others needed like a whole list. And if you really need to know more about something, we can always have a follow-up session to go deeper into some of the aspects that, that we've discussed. Yeah, I was trying to move the slides again. So yeah, I think that's the end of my presentation. If there are no other questions, I would like to end with a quote saying every decision you make in a business has a financial consequence. So whatever decision you're making, make sure that you are tracking the consequence on the financial side. By Barbara Vanchik. Okay. Otherwise, Mary, thank you for inviting me to share some tips on financials. If there are no further questions, I would like to hand it back to you. Thank you.
Thank you so much. Thank you so much, Annette. Thank you for giving us your afternoon. Your thank yous are still coming. Flowers to you, as we say in G4G. The ladies, I hope there's not too much financial jargon, and that we are better financial managers for our businesses going forward. Thank you, Annette. Enjoy the rest of your weekend.
Okay, thank you, everybody, and flowers to everybody. Have a nice weekend.
Nice weekend.
Bye-bye.
Bye-bye. Bye, everyone.